Christopher Tinker, founder of Libra Investment Services, joins me in the studio now. Thanks very much indeed for coming in. So when you look at what we've seen in US and European markets over the past few weeks, it's been very tumultuous, a great deal of volatility. What do you think is behind all this movement?
Well, this isn't about markets having a view on value or growth, really. It's just about massive shift in uncertainty about where investors think they can put their money, where they're safe in terms of making their investments. And because that question has been raised both in Europe and more recently in the US about what does safety really mean, I think what we're seeing going on here is a bigger structural shift. There's a reality check, if you like, saying, what are we doing just lending money to governments without thinking about it anymore? We're assuming that that's as safe as houses, but it's not even as safe as houses. You know, the uncertainty about possible defaults has meant that the whole investment landscape is beginning to change. We're in August, of course, which doesn't help. But the liquidity issues associated with what have been massive, massive holdings of government bonds over the years, people are suddenly thinking, oh, I've got to manage my risk in this somehow. There is a risk now. And if you're managing your risk, how are you achieving that? That's feeding through into equity markets, people using equity markets for those purposes to hedge. And that, I think, is at the root cause of people's uncertainty now.
So how do you manage risk in this environment?
Well, I think the first thing you have to recognise is that investment inherently is going to contain some risk. But the offset of that is the value opportunity that you may be presented with. And I suspect if we look at the way markets have acted in the last couple of months, it's been very much about reacting to headlines first and thinking about what happens next. And value opportunities arise when things get too oversold. I think that's how we started out this morning. People all having had their meetings over the weekend, sitting around saying, what are we going to do on Monday morning? The ECB sends its message, which is, we hear you, we understand that intervention in the bond markets is important.
Is it going to work?
Well, what is it seeking to achieve? What it's seeking to achieve...
volatility?
Yeah, well, the point about what investors are going to be owning longer term, do you really now go out there and say, I've got a great idea, I can make money out of lending to European banks and governments that might not give it back? Well, that's not the great idea. I've got to be paid enough of a risk premium for that, and the rate that I'm then asking the Spanish or the Italians to pay me can't be so high that they can't possibly serve it. So there's a trade-off that the market's going to have to re-establish here. There is going to be a longer-term review on that, but in the short term, it's the fact that nobody in the central banks or the finance ministries around Europe seem to be coming up with any kind of plan other than, oh, it'll be all right. And I think the markets almost put their foot down and said, no, it's not all right. We've got to think about things differently.
Beyond that now.
Yeah, exactly.
How do you explain the rally that we're seeing in European banks this morning?
Well, I suspect that one of the advantages that you have in terms of the way that prices get marked down and get marked up is that you get these potential rallies appearing to be dramatic, when in reality, you know, RBS falling 20% is not that it was suddenly worth 20% less, it was nobody wanted to buy it at the current price. And equally, the minute you expect shorts to possibly be closed, the European bank index has been a very obvious hedge for bond investors. And so if any of the tensions in the bond market are being relieved, the idea of shorts being covered in the European stocks banking index means that those share prices are going to get marked up very, very quickly as shorts get covered. So I don't think it's
temporary reprieve is what you're saying.
It's not fundamentally driven, but then the sell-off wasn't fundamentally driven either. It's all about uncertainty, and as those risks start to balance back, 4 or 5% moves in share prices are actually becoming the norm in the current climate. And, you know, 6 months ago, a 5% move was what got the headlines on the screens. Now it's a 15% move. So that's telling you the difference in the markets right now.
Okay, so it's not about value, it's about uncertainty. Christopher Tinker, thank you very much indeed.